My name is Jeffrey Backus, so good morning and welcome to our webinar, Predictions for the Franchising Industry in 2023. I am thrilled you're joining us today. We have a fantastic lineup of industry leaders, including Michael Iannuzzi, Jana Bras, Carrie Self, and Robert Masson, who will be sharing their insights and predictions for the franchising industry. Throughout the webinar, you'll have an opportunity to ask questions, so drop them in the Q&A box, and our panelists will answer as many of them as they can in the last 15 minutes of the session. Now, I'm excited to hand things over to our host for the day, but before we do, get ready for a great session. Let's do some introductions. Michael, why don't you start?
Sure, and thank you, Jeff, for the intro, and thank you, Dom, and everybody for putting this together, and especially to our panelists who took time out of their busy day to to join us. I'm Michael Iannuzzi, and I co-chair Citrin Cooperman's franchise accounting and consulting practice, along with Aaron Chaitovsky, my partner, who I'm sure many of you on the call know as well. Citrin Cooperman as a whole is a full-service professional services firm focusing on accounting, audit, tax, and business consulting. My group, the franchise practice, has a great team of professionals, many of who are certified franchise executives, and we work with many franchisors and multi-unit franchisees in pretty much every industry you can think of. We do all the audit work for the financial statements that go into the annual FDD filing, and then all the tax prep and consulting that go along with it. And I did see some of the attendee lists, and I'm excited to see many people in Las Vegas in a couple of weeks from now. So thank you.
Thank you, Michael. Carrie, you're up next. Carrie from Tacala.
Hey guys, my name is Carrie Self. I'm from Tacala Companies. We are the largest franchisee of Taco Bell with about 350 stores across about 7 states in the Southeast. My role here is very much about financial planning, system analysis, any kind of data analytics, that kind of thing, and happy to be here.
Thank you, Carrie. Jana, you're up next. Jana with Carrie.
Yep. Good morning. My name is Jana Bras. I am the finance director at Caribou Coffee. Caribou, if you don't know, is obviously nationwide, but our corporate office is in Minneapolis. So that is where I'm calling from, Minneapolis, Minnesota. And this is where we actually founded our first coffee shop 30 years ago. We have over 750 different units. Half of them are licensed and franchise units. The other are kind of our corporate company owned. We can be found domestically in the US as well as internationally. Internationally, we have a great franchise partner, and we just opened our first domestic franchise late 2022. Our coffee does expand beyond coffee shops. We do show up in your grocery stores, at airports, many other ways. I've been with Caribou for 11 years, always in finance, do a lot of the planning and analyzing of all the different lines of businesses. I would say my goal is to make more people love coffee and come more frequently, and really have enjoyed my time at Caribou and really excited about the franchise opportunity that's in front of us.
Thank you, Jana. Very nice. Robert, CFO from Redberry.
Good morning, everyone. My name is Robert Masson. I'm the CFO at Redberry Restaurants. We are a multi-brand corporate franchise business located in Canada. We have 3 brands. We have Burger King, where we have about 140 stores. We have Pizza Hut, where we have about 25 stores. And our latest addition to our portfolio is Taco Bell, where we have 15 stores. We have a tremendous growth path ahead of us in Canada. We've signed area development agreements to build about 150 Burger Kings and another 200 Taco Bells in Canada. So obviously great that Carrie's on the line, and maybe I can learn a little bit from her with all the Taco Bells she has in the US. But we're excited about our opportunities in Canada. And as I say, we're a corporate-run franchisee, so we take the lead from the brands that we represent. And excited to be on the call today.
Thank you, Robert. And last but not least, Mr. Dominic DiBernardo from Citrin Cooperman. Dominic.
Thanks, Jeffrey. And first, again, thank you to the panelists and also the guests that have showed up today to make time out of your busy schedule. My name is Dominic DiBernardo. I'm a partner here at Citrin Cooperman. I run the corporate performance management practice. We work with a lot of franchisees, implementing, software that helps automate a lot of the reporting and also facilitate planning across the organization. So I'm happy to act as the moderator today to tease out some insights and learn lessons from the experts here that spend all their time in the franchise space. Particularly, obviously, we got a heavy emphasis on food service here, and then Mike will be able to provide probably a broader perspective or lens across other industries within the franchise space. So thank you again, and looking forward to getting into the discussion here.
All right, Dominic, let's kick it off.
All right, thank you, Jeffrey. So the first thing I'd like to jump into with the panel here is I'd like to talk about your outlook, for the franchise industry, in 2023. We're coming off the back of several years, after the pandemic initially broke out. We've had lots of discussions around fears of recession. Are we in a recession? Are we not in a recession? We've got rising interest rates. We've got labor shortages, supply chain issues. So I'd love to kind of hand it over to the panel and see what you're seeing in 2023 and beyond. What are you doing to mitigate risk? What are you doing to avail of opportunities? Anything along those lines in terms of what your outlook is in 2023. If someone want to volunteer, I can also call on someone as well.
Sure, I'll go first, Dominic. I would say starting first with just inflation and interest rates. I think we learned a lot going through 2022. When we were creating our plan for 2022, I remember us specifically stating, we were being conservative and using a food inflation rate of 7%. And at Burger King, we ended up with an inflation rate of 18%. So we got completely surprised by the aggressiveness of the inflation that we faced, and that was a battle the whole year. And obviously, once interest rates started going up, that obviously affected us as well. We're managing through it. It's a day-to-day battle. We look at our menu pricing, on a constant basis to see what opportunities we have, and we take a lot of direction to see what's happening in the U.S. as well, and we have been fairly aggressive in our menu price increases. And the good news is our brands are quick service restaurants, so I think we're seeing people trade down from upper scale down to quick service, and so we're benefiting from that. In terms of the pandemic, we went through it very well. We have a large part of our portfolio is drive-through, so we had people shifting from in-room dining to drive-through, so we benefited from that. And then the likes of third-party, Uber Eats and the others, again, we benefited from that, where it was almost non-existent with our Burger King brand prior to the pandemic. All of a sudden, it ramped up. With Pizza Hut, it was already, that model was already there in the past, but that just strengthened that brand. And then, Taco Bell is, I would say, is one of the leaders in that space. They, we're approaching, 30% mix on the aggregators, and maybe it's just the demographic, younger people that are more attuned to that way of ordering and things, but that's certainly doing well for us. So overall, I think we're optimistic about 2023. We think inflation's gonna start to taper down. We're still very cautious. We're not declaring victory yet, but we're looking forward to a better 2023 than 2022.
I would echo that. Yeah, I would echo that. Being also in the Taco Bell industry, we're primarily Taco Bell, but we are very optimistic for 2023. We were, again, conservative in 2022. We weren't sure how the quote unquote first year out of the pandemic and with no world events, that turned out to not be the case at all, as we all know. But for 2023, we have learned our lesson. We are staying very conservative, but we're optimistic. The labor shortages have lightened a little bit. The wage pressures are absolutely still there, which we have planned for. We expect that to continue, but the labor shortages are starting to decrease. We hope that trend will continue as well. We're putting a lot of investment in technology as a brand. A lot of kiosks, a lot of third-party aggregators. We have launched delivery through the Taco Bell app, which, again, I think, as Robert mentioned, our demographic is a little bit more likely to use that kind of technology. So we're happy that that's going to continue and hopefully help us offset a little bit of that labor shortage. The rising interest rates, we're significantly hedged, so that really hasn't affected us so much, but we're excited about what the future holds. Again, being very conservative with inflation in general, but very optimistic about 23.
Hey, Carrie, just to double click before we go to the next panelist, you mentioned you're making heavy investment in technology, and you got a lot of third-party aggregators, I'm assuming, for food delivery service. I'm curious, like in the pandemic, you read a lot about food delivery service being increasing significantly as people couldn't go out and actually go to the restaurants or didn't want to leave their homes because they didn't feel safe. What did that do to margins, and what are you seeing or doing to mitigate that? You mentioned that you're taking orders through the Taco Bell app itself. Like, are you seeing margin compression? You might have a higher order volume from the delivery service, but I'm curious what that's doing to your overall profitability profile for the business.
Sure. Yeah, I think the pandemic really gave us an opportunity to push a lot of changes through that we wouldn't have otherwise, or we would not have rolled out as quickly otherwise. The pandemic really did a lot for technology in that particular respect. We are seeing a tiny bit of compression in the margins just because there are fees associated with all of those third-party aggregators. I'm sure you're all aware that the markup is high in those apps as well, and that's to help offset some of those things. We're excited about what we can do with the what we're calling first party delivery, which is through the Taco Bell app itself. The margins are much better there. The markup is non-existent. Insider tip for those of you who are Taco Bell fans. So I think that that's going to do a lot for us. The margin compression has been minimal, I would say. Definitely worth having the aggregators. I wouldn't say that it's enough to really be any detriment to that mode of service.
Okay, thanks, Gary.
Yeah, Dominic, just to add to that, I think when the aggregators kind of exploded on the scene, through the pandemic, I think everybody was just trying to get it on as quickly as possible. It was really a reaction, not proactivity. And so I think now we're re-looking at everything, right? We're re-looking at how the restaurants are set up for success, like with specific areas for the drivers to come, better servicing them, making sure that the food is kept warm, all those types of things. And we're also looking at the premiums we charge on the platforms, right? And I think everybody was very hesitant in the beginning to charge the premiums, but studying a lot of brands and what they do, and it is also a little bit location dependent. Like in New York City, they're going to charge much higher premiums than if you're in a very small town where maybe aggregators aren't as prevalent, right? So I think looking at it all and to try and offset some of that margin impact is critical, right? And we're re-looking at all of it.
Awesome, thank you, Rob.
Yeah, I would echo everything that Robert and Carrie had said. I think we, not just like everybody else, super caught off guard by the inflation that came through in 2022. I do think the one thing we've realized with our guests and customers, we're all experiencing it, and customers are willing to still pay for this. So we've continued to see that. And so that has been positive. There's very few that kind of walk away, right? It's a select few that are doing that. As we continue into 2023, that's our big focus, is how do we ensure that we're growing our traffic? We want to continue to make new friends, but also those that are coming, how can we increase their frequency? I think with all the pricing actions that we've taken to offset cost of goods or labor pressures, it's changing basket sizes. For us, it's really, maybe it's not that extra muffin every time you go. Now it's just the every other. And so I think for our teams, what we've been really focused on is just how do we ensure that we're cost engineering how our products are made, things that like our drinks, we make those in-house. So that is multiple ingredients going in. What is something that we can take out? How do we ensure we're not wasting more so that way we can continue to have those great margins? From a labor standpoint, the biggest thing, we as a company, everyone in this group probably customizes a drink in a very different and unique way. How can we make the store teams more efficient, more productive, and take out a lot of that work? And then that is whether it's the front of house, back of house, and how that looks. So we're continuing to try to find efficiencies through how our stores are working, so that way we can pay our team the correct wages that they need. Because guess what? They're the first people that guests see, and if they make that guest happy, they're going to come back again. And so if our teams are happy, our guests are happy. One of the things I think that we've really expanded with everybody else is kind of that Uber Eats component. We did try to do some in-house delivery on our own. It just wasn't something that we could confidently do with our general managers driving to stores, right? It's kind of it's a liability component. And guess what? We're a coffee shop. We're not drivers. And so we're continuing to look at Uber Eats. They do have this new platform, Uber Direct, and we're really excited about that. It comes right through our POS. So leaning on companies that are continuing to leverage how they be more efficient too, I think has been really helpful. Like, what are others doing that we can bring in-house to ensure that, one, we are meeting our guests where they want to be met at from a convenience standpoint, but also ensuring that our quality of product shows up the right way too. And so I would say, we're continuing to see it. We are very optimistic about 2023. The team is important to us, and I'm continuing to ensure we can cost engineer what our product is and how do we make our store teams' lives more efficient and effective.
That's great. No, and it sounds like I hear optimism across the panel here, which is always great versus the alternative of doom and gloom. It seems like you guys have done a decent enough job being able to pass on, the increased, price to your customers, or you'll continue to bleed that through the system if you were caught off guard. And it sounds like there's definitely a consensus in terms of inflation tapering as we move out throughout the year. But I think the striking thing to me, and maybe everyone in the audience kind of picked up on this as well, is there's the reported inflation rate, and then there's the unique inflation rate depending on where you are in the ecosystem. So having an 18% inflation rate for your cost of goods sold versus maybe a reported somewhere between 6 to 9% inflation rate, depending on where we were in the course of 2022. I'd be curious to ask just one last question to Michael, as you've worked with a lot of franchisees over the course of 2022. Anything else you see strikingly different versus what the panelists from their lens?
No, and I want to hit this from a slightly different approach. So there's something unique about the franchise model and the community and the way it pulls together in recessionary times, during COVID, whatever it is. And we saw this when COVID really hit. Between all the industry organizations that were out there, the amount of resources that came out to the franchise community, I think, far exceeded any other types of business models that were out there. And plus all the lobbying that the IFA did on behalf of franchise businesses to get things like PPP loans, the ERTC credits, and things like that. So from that transition towards 2022, as people saw how well franchising faced, private equity accelerated their investment in the franchisor side, the franchisee side, and even the suppliers were seeing private equity investment. So I'm very optimistic and excited as to what 2023 is going to bring. I also have monthly franchise supplier calls with various different professionals that service the franchise community, and they're all saying the same thing. So I hope we're all right and that something doesn't go the other way. But you see this with the broker groups and the development groups. I mean, franchise sales are exceeding, pre-COVID levels. So it just tells you something about how strong the business model is. And I'm still seeing, private equity investments starting up in 23. And I'm seeing a lot of startups come to market that have raised capital before even coming to market with a brand new concept coming to market, which didn't really take place years ago. Years ago, startups just had a couple of units and they started franchising. Now I'm seeing they have a unit or two, they're raising capital, and now we're going to build a franchise model. So interesting and exciting times coming up in the next couple of years.
Thank you, Michael. That's actually a good segue into the next question I want to pose to the panel here. And that's really around the continuous interest from private equity. And as you're saying, you're seeing that, that level of interest, not only maintain, but also increase and continue into 2023. Some might ask, well, is the appetite still there as interest rates have gone from near zero to 5-6%, wherever they end up landing at the end of 2023? But relatively or historically, those rates are still relatively low. So what I'd love to kind of understand is, from the panelists, I know not everyone has private equity or a private equity sponsor involved, but if you do, maybe you can speak to your experience, having private equity, and what are the KPIs? What's important to them? Like, has growth become more aggressive, less aggressive with the rising interest rate environment? What can you tell us about your experience with private equity and your business model?
Sure. I mean, I can start. So at Redbury, we are owned by a private equity firm based out of Chicago, City Capital Ventures. They do tend to invest in food service companies. They also have an investment in another Burger King portfolio in the U.S. as well. So they're very familiar with franchising, and I think that's one of the trends that I'm seeing is I think the corporatization of the franchisee side of the business. A lot of startup brands will obviously go the mom and pop franchising route to try and grow quickly. But I think with a lot of the established sort of international brands, like Taco Bell as an example, I've recognized the importance of having well-run, professionally run franchise businesses. And I mean, it's been going on, I think, a lot longer in the US. In Canada, we're fairly unique. There's not a lot of Redbury type companies here. So we like to think we're sort of leading the charge on this. And I think that's going to continue. And I think a lot of private equity firms will probably get more into the franchisee side of it. If you're dealing with a recognized strong brand, there's less risk there. You're really just taking on the operational risk of executing from a franchisee perspective. I mean, our shareholders are very interested in our KPIs. We're obviously a high growth company. We're growing. We're opening up a lot of new stores. So we're focusing on cash on cash return. We obviously want to focus on our base business as well and make sure we don't neglect that as we grow more stores. So return on investment on our existing store base, same store sales, margins, those types of things. And it's one of the reasons why we implemented Vena, because with 180 stores, it gets really difficult to do that in Excel. And we were kind of pulling our hair out and saying, every store is a profit center. And that's the way we run our business, right? We've got to go down to every single store. So it was really difficult, and we're happy we went down that path. So certainly, I think a lot more private equity in the future.
We're also private equity owned by a group out of Palo Alto, California, Altamont Capital Partners. And unlike what it sounds like Robert's experience has been, we were actually, I think, the first franchise that they went with, and they are not necessarily food service focused. So they've been very happy with the investment. I agree across the board that I think more private equity will go into that corporatized franchisee model. I know that they've done several different brands. I think there are some fitness concepts and some other restaurant concepts and movie concepts in their portfolio now after they kind of saw what the franchisee model can do. I know for Taco Bell, I think it's just the age of the brand. Like, you've got a lot of those mom and pops that have run their mom and pop stores, franchises, and they're ready to retire. And so I think we'll see a lot of consolidation in the near future there. But I definitely think that the investment is a sound one. You're truly operators, and that is where the franchisee model can really, really work for investors. Is you're not, for us at least, the brand is coming up with the new concepts and the new builds on different menu items. They're giving us guidance as far as pricing. They've got large co-ops that kind of offset some of that inflation and can do that predictive analysis for us, where we as franchisees can really be focused on operating and really running good stores and being the customer facing side of the business. And I think that is cash on cash returns on that are just, they're absolutely there in most of the franchising models. And I think that we'll see continued investment down that path.
Yeah, I agree. And it's no secret that private equity loves cash flow. And I think when you have both sides of it, on the franchisor side, you can really model out and predict future cash flows based on the way the unit economics are of the franchisees. And of course, if the franchisees aren't making money, the franchisor is not making money. So for any startup franchisors that are listening, number one priority is your franchisees. Make sure they are making money, future cash flows, they have what they need to succeed and grow multiple units. On the franchisee side, years ago, if anybody remembers the Planet Fitness craze, multiple franchisees were rolling up into private equity models, and most of that system at this point on the franchisee side is probably private equity owned as they continue to roll up, and then the roll-ups are rolling up into smaller ones, and then they're just becoming these conglomerates of multi-unit franchisees that are out there. So I think that's definitely going to continue. We are seeing it on the supplier side as well. Private equity is jumping into franchise development type companies. So I think just overall, everybody's very excited at what's here and what the future is going to hold. I will say, though, you always want to be prepared. So make sure your books are in order, make sure your records are in order, make sure you have signed franchise agreements, you have all the confirmations, the addendums. Don't come to the table with a sloppy package, come to the table ready to go. That will help boost your valuation in the future.
Yeah, and just before we move off the topic of private equity, some of the things that that I can personally think about is terms of benefits for the operators that are on the call that have multi-units, and they might be circling around in their head. And Michael, you might have some insight on this, and maybe the panel does as well. Is when does it become feasible for private equity to be interested? Is it 20 units? Is it 50 units? Like what's the size of critical mass before private equity would really be looking to make a stake? And also, like, in terms of the benefits, right? You've got operators that Carrie talked about, in terms of maybe they started, they're getting ready to retire, and they want to take some take their chips off the table, but they want to leave a sustainable business behind, and bring on a capital partner to help through that transition. Other things. What are the other benefits you're seeing from private equity besides the capital to continue to grow and kind of get this kind of liquidity event? You might have been growing your business for 10, 15, 20 years, and now you're ready to kind of move on to your next chapter. So can you speak to that a little bit, Michael?
Yeah, I think, look, the ultimate benefit is going to be, capital and return on investment. But as the units start to grow and start to develop, that's the name of the game at the end. In terms of just overall performance, there's certain things that, need to take place as you're getting ready to sell. You may hear things like the quality of earnings report that gets thrown around. A lot of private equity firms like that, even some banks are asking for that type of reporting as well when they're going into debt deals. And it's throughout all different services. It's not just the food service, it's the private home service businesses, there's the roll-ups. But in terms of size, Dominic, like you were saying, it used to be that private equity was looking for $5-10 million of EBITDA. I think what's happened is that a lot of those concepts have been acquired already. So now some of the bigger private equity firms are going at the startup level, and they're looking for the startups, 1 or 2 units. They have good operators, maybe they have a couple of good company-owned locations, and they're looking at this thing as saying, well, if we come in now, we're going to grow this thing to 500, 1,000 units, and then we can flip it. So it's really changed over the years from the bigger players coming all the way down to the startup level.
I think the other thing I can add to that is I think the business model is also critical, right? I think whenever we are obviously also looking for other brands that we can add over time, and I think one of the key differentiating factors is really can you scale this business? There are certain franchise concepts where people are really just buying a job, and the unit economics of the location is too small to put in a paid manager, right? And the franchisee is essentially just buying a job, right? So I think we would steer away from those kind of concepts, because we would want to run it professionally and put in a manager in the store, and then obviously scale it from there, right? And so I think that's one of the things that people could get into trouble if they wanted to scale a business that is not really scalable.
Interesting. And the final question I have on this particular topic is, with interest rates rising, and in your guys' own experience here, probably this is geared more towards Rob and Carrie. When it comes to growth, are you seeing any let up in terms of gas or foot on the gas in terms of like, okay, hey, we want to go move forward with a little bit more trepidation because of the surprises of the last couple of years that just kind of keep hitting? Or is it full speed ahead in terms of, your experience so far?
I would say for us, it's very much full speed ahead. Where we're building 15 stores a year easily, and that has not slowed down at all. We've got great partners on all sides of that.
Yeah, I think we're cautiously optimistic. I think we are hoping that the recession or slowdown, whatever you want to call it, does bring back into balance some of the construction side of the equation, because we're seeing a lot of inflation in building new stores, whether it be the materials of the store or just the availability of the construction labor. There's too many people trying to get access to a limited supply. So we're hoping that the rise in interest rates is going to temper some of that and take some of the froth out of it, so that we can continue to build our stores without the significant construction inflation we're seeing in it. Whether it be from the landlord side, where they're building the shell for us, or just acquiring land that's becoming too expensive. I think so. We're really we're hoping that it does take some of the froth out of it.
And Rob, just to double click on that, what are you seeing significant delays in terms of how long it takes you to open a new store because of labor shortages and supply issues, or or is it just simply a rise in the cost of the construction of opening a new store and acquiring the equipment to operate?
Yeah, I think I think we're seeing the after effects of COVID on the municipal approvals of permits, and those types of delays, where a lot of the municipalities we're dealing with are still dealing with a hybrid workforce. Everything's taking longer. Something that used to take 4 to 6 weeks to get a permit now is 16 weeks. So it's all just taking longer, and that has significantly impacted us. We opened way less stores than we had planned last year, and they've all kind of slipped into 2023. And so we're just regrouping to try and figure out how do we make this process better, because the permitting delays has been quite substantial, and something we're working on.
Okay. And I'd like to remind the audience, as we move to the next topic here, we are going to try to reserve about 10 to 15 minutes for Q&A. I have seen some questions posted in the Q&A, so I just want to encourage you guys, if you do have questions, go ahead and post them up there. They're just queuing up for when we move to that section of this particular panel discussion. So the next topic I'd like to move on to is there's a commonality between the three different panelists here, and that's that you guys are all leveraging a particular application to help you run the reporting and analytics across your business, the planning. You guys have mentioned units in the hundreds, which can be a bit cumbersome to manage if you're trying to do that just purely out of a spreadsheet. And you probably have different levels of sophistication across your different store managers and things like that, in terms of what types of metrics you need to get to them to keep them focused on the metrics that count. And that is you guys are leveraging Vena, and that's an application that my particular practice, I joined the firm through an acquisition a little over 16 months ago now, that we've been implementing for not just unit franchisees, but many different companies across many different industries. But I'd love to kind of get the perspective from each of you, because you've all have been on Vena for different periods of time. I think Rob, you've been on for a little less than a year, and Carrie and Jen, I think it's been at least, I think, 8 years for Carrie. I'm not sure, Jenna, how many years you've been on Vena, but maybe we can start with Rob, you being the youngest user of Vena, in terms of your experience. Why'd you buy Vena? What are you leveraging it for in terms of this first phase over the last 9 or 10 months? And what do you look to do with it over the next 12 to 24 months and beyond?
Well, Dominic, I'm glad you called out that I was the youngest person on the call. That's great. But no, we started our journey with Vena probably a year ago. Scoping it out, checking it out, and just planning for it. And no, I think we were successful. We successfully did our first budget in the fall and finished it in December. And really, we couldn't have done it without a platform like Vena. As I said, we treat every store as a profit center, and our restaurant general managers have a bonus plan in place based on the profitability of their store. That's enabled us to really improve our accuracy, our reporting, the timeliness of it. And I think we've got, plans to take it even further and, maybe get into some, sales analytics, going down that path, understanding our menu pricing and food costs and things like that. So I think we're in the early stages of it. And our team is, we obviously our FP&A team is sort of, very much in it. I think we're trying to get our accounting team to use it a little bit more. I mean, they weren't as involved in the first phase. So it's a bit of a training process that we have to go through. It's, obviously everybody takes change differently and different tools, but we're certainly excited about what the possibilities that this has opened up for us, and we plan to, use it a lot more in the future.
And before the next panelist goes, for the benefit of the audience that may have never heard of Vena or doesn't know what it is, let me set a little context. So Vena is an application that allows you to automate all your internal and external reporting. So you may have different reporting formats that your internal management team are consuming in terms of how you run and operate the business and the metrics that are important. You may also have different views if you are private equity backed or you have a lending facility in place, and you have different covenants that you have to report against, and other reporting requirements. It also brings to the table a workflow that helps you drive a self-service and self-management model where that reporting that in the old paradigm was done manually by someone, extracting information from your different source systems, compiling it, manipulating it in a format that is consumable, and then sending it out to throughout the organization, where Vena becomes the central source of truth, integrating directly to your source systems, bringing workflow to the equation to have collaboration across the organization, but also to provide the business with a holistic view across, whether you have 5 units or you have 500 units, it doesn't matter. It scales with your business very well. And it also brings the ability to have deeper and more automated analytics, which helps you get to insights faster and ultimately allows you to partner your finance organization as a strategic partner to help your business leaders understand the levers they have to pull to really optimize top and bottom line results. So that still may sound esoteric, but I wanted to kind of give you an overview of what Vena is in case this is your first time hearing about it before the next panelist describes how they're leveraging Vena. And they're going to be a bit more mature in terms of the path they've been on since they've been using Vena for longer than the last 9 or 12 months that Rob and Redberry has been kind of going down their journey. So Carrie, would you like to go next?
I think Jana has, I admire the way that Jana has
Okay.
her solution set up. So I think that she will be best going next.
Okay, no, sounds good. So we've been using Vena about since 2017. We did dabble a little bit before that, but we went through a pretty big ERP GL structure change, which then confidently made us start using it in 2017. I'm a huge fan of Vena. We use it for our 350 corporate owned stores. We have one model that works for all 350 stores. We love the flexibility that the tool has. We love that we can use one Excel tab for all of our stores. And how do we identify that? Vena has the benefits of Vena are just the flexibility. So how kind of what Dominic, you were saying about, we have our internal structure of who wants to see which stores, how they want to see it, but then externally there could be different views. So based upon store type, age of store, in different ways. And so we can set up all those different hierarchies in a very unique way. And I think that has been such a benefit for us. How it works from like our store perspective is that, each store has a DNA, right? They have a percent of mix that is unique to that store. And we can build a plan that is very specific to each individual store while giving the same inflationary targets, the same wage merit components. And they can absorb all their unique attributes within their stores. And so we love the fact that we've gone from 300 plus tabs down to one tab, one model, and the enhancements that Vena continues to make and making the planning process easier and better has just been really night and day in how we were able to do this on a go forward. We don't have a ton of our accounting folks using Vena, but I think that's continued usage of in getting them in there. So it is much more of a finance tool, continues to be at this point, but there's lots of opportunity to grow and expand, even with other platforms with our capital planning process, as well as kind of our workforce, overhead.
I would echo everything that Jana said and that Robert said. I'm a huge fan of the platform. I think it's infinitely flexible and infinitely scalable. We have actually run at various points 3 different brands in the software. And when we're about to go into a new brand, and when they said, hey, how are we going to do reporting? It's like, okay, that's not a thing. That's a 15-minute setup, not a big deal. Very easily scalable, very easily manipulable in any way that you want to do it. So huge fan of that. And yeah, I don't think there's much more to say. I think it's been fully covered.
Yeah, and I think one thing just to add a little more insight, I think for the audience here is, what Vena allows you to do when you're operating at 300 plus units as it sounds like all of you are, or very close to it, is instant aggregation. So long gone are the days where if your FP&A team, your finance team is sending out, say, budget or forecast templates, that's 300 plus different packages that they used to send out via email or to a shared point, and then there was someone in finance that was rolling all that up and aggregating it. Hopefully people didn't add lines in the Excel template or break formulas, and things were rolling up, and it was a very cumbersome, manual and hellacious process. Where what Vena does is, you heard Jana describe one tab from 300 tabs. Is Vena is an application that sits on top of Excel. It essentially turns Excel into an enterprise level FP&A solution. It gives you it allows you to maintain the flexibility of Excel within a controlled environment. So Vena does run in the cloud. It runs on AWS Web Services, best in class. And the Redshift database, things like that, where you have all the database stuff going on, where it's aggregating your data and putting it in a format that allows you to slice and dice on things that make sense for you. But it also makes sure that people only see their version of the world. So there's a very robust security model where you can get very, very granular. Where gone are the days when I first started out in finance, and let's say we're working on a headcount planning exercise, and obviously there's lots of sensitive data with salaries and bonuses and all those things. I remember accidentally sending a file that had 300 employees to the wrong John in the organization, and I thought I was going to get fired. Where that's not possible with Vena now. Like, even if someone is exposed a report that say has all the salary and bonus information, if they don't have the right data permissions, that report, unlike a traditional Excel file, is not stored with static information. It loads on the fly after security is checked. So just to kind of add those extra little tidbits there, you also heard the panelists talk about the difference between finance and accounting use cases. So Vena is not just an application that the finance team can use to help operations understand their performance and what they can do to improve that performance, but it's also a way to gain efficiencies in other areas of the back office. Accounting is one of those places where you can digitize the month-end close checklist to bring efficiencies and accelerate your time to close the books every month. You can automate your account reconciliation process. We've got plenty of examples where teams have taken the time to do their account reconciliations, and they're saving 70 to 95% of the time it used to take their teams. I mean, you're talking hundreds of hours every month across accounting teams, across many different clients. What I really want to leave you with here before we move on to the Q&A section, actually we got one more mention for Michael, but is think of Vena, if this sounds interesting and you're running a lot of units and you got a lot of headaches, as a platform that is data, people, and process agnostic. So anytime you have data, people, and process that you have to marry together, Vena becomes a really good platform to ease the pain points across the organization. And so I'll leave it at that, not to make this a Vena commercial, but you got the panelists here that have gotten a lot of value out of it. And we think in the franchising space, it's an application that can really bring a lot of value to everyone else on the call as well. So with that being said, what I'd like to move on to before we get to Q&A is, Michael, we were going to kind of talk a little bit about maybe a mention of the IFA and what that is, and also other resources that are out there for organizations that are kind of in the franchisee or franchisor model.
Sure. Yeah. Before I touch on that, I just want to say you can hear from the 3 panelists that they have their stuff together and they know what they're doing. So whether you're a franchisor or a franchisee, I mean, you should want to strive to build your organization the way the 3 panelists are doing, because that will pay dividends in the future. In terms of resources, so I'm a big fan of the International Franchise Association, the IFA. I've been going to that conference for the past 10 or 12 years, I think, Our firm has been members for years. My partner Aaron has been going there for years as well. It's a tremendous networking educational opportunity. I think many of the fellow suppliers and even a lot of the franchisors, franchisees will give a lot of credit to the IFA for, for their success and making the connections that they've made over time. So I'll be looking forward to seeing everybody out there in the next couple of weeks on February 25th. And I'm also curious to hear from the other panelists, what are some things that they've leaned on in the past to help them and their companies get to where they are today that could be beneficial for the people that are listening in.
I'll say one of the conferences that we get a lot of value out of, we haven't gone to the IFA conference many times, but the Restaurant Finance Conference, if you guys are looking for financing or a place to get into private equity or a place to find funding or just a place to touch base with your current funders, the Restaurant Finance Conference in the fall is a really great resource. Great panels, great education, great connection points there, as well as the IFA conference in the spring.
I would just echo that in talking with our chief franchise officer, we're just starting to continue or to invest in our teams and trying to invest in building some of those industry relationships. So as he had spoken to me about, like, IFA is just really critical for education and networking, super important. And he's also found a lot of value in the Restaurant Finance and Development Conference, as well as the ICSC, so the International Council of Shopping Centers. So both of these, really important just to get messages across, learn from the best in the industry, who's doing it well, how can we do it differently, and just network with, potential candidates, other professionals, and franchisors. So we obviously need a lot as we continue to, support our growth initiatives, and I think those are all very helpful.
Yeah, I mean, I would echo what Jenna and Kerry have said about the Restaurant Finance Conference as well. I went to that as well and found that very valuable. You meet a lot of multi-unit franchisees there. You meet some of the franchisors, some of the the investment community. So I think it's a good combination of people. I think we also find value in going to the brands conferences. So, we go to the Burger King's brand conference, we meet with other, multi-unit franchisees there, Taco Bell as well. So I think that's also great to network and find commonalities and, how they're running their business. So I think both of those, we enjoy being part of that.
Great. No, really appreciate that. And if you guys are in the audience attending the IFA, make sure you go and visit Michael, and Jeffrey will be there as well. If you have any questions, that about Vena or about anything else that we've talked about today, I'm sure the two of them will be happy to connect. There also will be, I think, Jeffrey, you're going to be doing a demo at the booth as well, if people want to kind of get a visual of what Vena looks like in action.
That's correct. So during the breaks and the luncheons, we will be presenting with Vena. So please stop by the booth and we'll make sure to get you a good demo. That's for sure.
Okay. So now we have about 12 minutes left for some Q&A. I do see a question in here from Mark that I'd like to read out. It looks like it's actually geared or targeted towards you, Michael, but if the rest of the panel has a view, I'm happy to have multiple answers here. But it says, press reports, general and finance say that PE is a bit more conservative this year, waiting to see potential shakeout in the economy. Where is inflation rates going, etc. But are PE firms with an interest in franchising bucking that trend and still aggressive on franchise investments?
So yeah, good question. Hey, Mark, I'm sure I'll see you in 2 weeks as well. So it's interesting. I agree with what he is saying, and I think that is the case. And at the same time, when I speak to the investment bankers and the private equity shops, the second they say, if you have something come across your desk, please call me, and we call them, they're responding immediately. So I think there's still an appetite for the franchise businesses. Maybe multiples will be depressed a little bit, but I still think that the strong players out there are gonna take and run with the brands that they can get their hands on and look to grow and expand them in the future. I just don't see it stopping, because I'm hearing that it's still taking place, and you see announcements on LinkedIn all the time. This sold, this group just got rolled up, this new investment was made. So the announcements are still coming, and I think the deals are still going to keep going forward.
Thanks, Michael. Anyone else have a view on that before we move on to the next question? No? Okay. So Evan is asking, how is hiring going? I know we talked a little bit about the labor shortages and wage pressure earlier, but maybe you can speak to this from both the perspective of how is hiring going, for what I would call the front line in terms of the store level employees, but also there might be some issues in terms of the back office support, right? When you're running 300 plus locations, there's a lot more than just the store employees to provide all the back office infrastructure to make sure that that those stores are well supported and that you have the talent needed to run the entire organization. So someone want to take a stab at that? How is hiring going?
Yeah, I mean, we're still finding it tough. So we've actually we're partnering with some firms to bring in some temporary foreign workers. Canada has a particular program where we can leverage that. It is quite a long process, and we use it to bring in manager level people at the store. So we're starting to see some success for that. When we look at both Burger King and Taco Bell, about half of our staff are temporary foreign workers that will eventually move to Canada and set themselves up, and we find that very beneficial. From a back office perspective, we are seeing a bit of the pinch, and we're actually trying some different way of doing it. So we recently started offshoring some of our accounts payable processing. And again, it makes it possible when you use cloud-based systems to enable that. So we have a team in the Philippines that is doing our accounts payable, and we're now looking at using some offshore resources for doing some of our bank reconciliations and that. It's just to sort of ease the pressure on finding good people in Canada, and we want to rather have better quality sort of knowledge workers and try and sort of get some of the sort of repetitive work done at a lower cost and using systems as well.
I would say for Caribou, hiring is going better. And so in the last couple of months, I wouldn't call it a trend yet for at least another month or two, but we are seeing a lot more applicant flow, which is really great. So we have more selection, we have more options to choose from. And also our HR team really continues to work on, from the moment someone applies to the moment they're hired and in store, like continuing to shorten that time. Early pandemic, it was, or throughout the last few years, it's been kind of varied. And so we would lose people in that time because they'd be going somewhere else. And so we're down to about 14 days is kind of went from start to finish. And so continuing to ensure that we're staying connected, we're responding, we have the technology to respond quickly and the resources to go. So I think those have been really helpful for us. It's just shortening the time. But hiring, it's great to know that we have more applicants coming and more to choose from versus just the onesie twosies where we feel tied.
I would echo that as well. We're seeing a better applicant flow. We've got a lot of technology enablement, both in the frontline facing things. I think our applicant flow is very much down to less than a week if we can get people through that process. So technology is huge there. I would say back of house as well. Our AP processes, we've got some AP enablement in place that has really allowed us to scale without having to hire additional. So in the finance world, it's not terrible. I think where we're seeing back of house shortages is really in our construction development. We have an in-house construction and development team, and I know that they are having a really, really hard time finding the right credentials at the right price point. People out there, but we've leveraged recruiting firms fairly heavily. It comes with a high cost, but we are getting decent people. It's a tough world out there, but it's getting better. I think I will echo Jana's, like, it's not quite a trend that it's getting better yet, but we're optimistic.
Seeing the green shoots. The other question I have, there's no other questions in the Q&A box, but there's one I wanted to ask earlier. I'm curious if any of the panelists, are you guys, I've heard investment in technology, but what I didn't hear specifically, and I've been reading a lot about, robotics in terms of, being leveraged inside the franchise, particularly food industry, the automated, robot fryer, hamburger flipper, things like that. I'm curious, are you guys leveraging any of that technology? Are you thinking about leveraging it? What's stopping you, or what's actually kind of what would get you on that trend that you seem to read about on a daily basis these days?
I mean, we're looking at kiosks. I think it's very early days. I think some people naturally just think, well, if you put a kiosk in, you're going to save labor, and I don't think there's quite as correlation as you want. But I think people are becoming more used to using technology when they're ordering food. I think Taco Bell has done a lot of testing in this area. So Kerry, maybe you guys are further along than us, but we certainly think that might help with some of the the labor challenges. And in a market like we also operate in Quebec, where there's a French language requirement, and it might enable us to have kiosks for order taking, and maybe the people in the back of the house cooking the food don't necessarily have to have that French language barrier, right? So it might just ease some of that. But we also think some of the urban concepts we're looking to do, we might use more kiosks and try and change up the store format so that people are almost forced to use the kiosk, as opposed to having a digital menu board as well, where people then will maybe walk past the kiosk and go to the cashier anyway. So yeah, it's a bit of an experiment for us, but I think we're looking forward to testing it out.
Great.
We've had a lot of questions, particularly about minimum wage hikes. I don't know if you guys how you're addressing that, particularly in California, for example. Is that affecting the business at all? Just the raise of minimum wage across the states here in the United States, or maybe in Canada as well?
Yes, we're definitely seeing those pressures, and you're seeing those minimums go up state by state. Right. I know Virginia has just put in place some very, very strong policies that are kind of a multi-year rollout. So it's something that we're having to plan for. It's definitely compressing margins, but to the earlier point that Jana was making about the way that Vena has enabled us to look at that on a very, very store level with similar inflationary expectations, but really focusing, I like the way she put it, on the DNA of the specific store. I think that has really helped us manage those type hikes. We can do some things with pricing. We can do some things with labor deployment. To Robert's point, the kiosks are not really taking labor out of the stores, but they are allowing us to kind of redeploy a little bit, which has been nice.
Thank you.
Canada, we're also getting, we had minimum wage announcements last year in Ontario and Quebec. Manitoba went up, I think, over 10%, but they were low to start with. But I think more of it is coming because it always lags. We've had massive inflation, and I think I think that's probably still going to be a bit of a surprise 2023 and 24, but I think it's coming.
Well, we're getting close to time here, so I want to wrap up, and I want to thank Jana and Kerry and Rob for taking time to be on the panel, and Michael, thank you for giving your lens as you head up the franchise practice for Citron, and I'd like to thank all the attendees for showing up today. This has been a very interesting discussion. I know I got a lot of insights out of this and found some things. It'd be interesting to revisit this conversation in this panel a year from now to see how the optimism played out, and hopefully it greatly exceeded your expectations. And I wish everyone a happy and fulfilling year ahead. And like you said, if you guys are going to be at the IFA, please visit Michael and Jeffrey. Thank you so much for your time today, everyone.
Thank you.
Bye.
Thank you.
Thank you.
Bye, guys.